Hey, what's up guys, it's John here, back with another public stock portfolio update. And as usual, we're going to do a quick recap of the market. Then we're going to go into the different moves that we made in the public account. And I'll also give a recap of how the entire portfolio is doing as of today. I'll do a quick update of the AMC challenge. And I'll also talk about important things to watch out for. So as usual, if this video provides you any value, please consider hitting the like and subscribe button. And let's get right into it. To recap what happened in the market this week, we started off the week on Monday pretty flat, but then on Tuesday, the market started to move up. Later on Tuesday, it started to flatten out again. And that lasted all the way until midday Wednesday. Then from midday Wednesday, the market started to run all the way until Friday morning. And then we saw a slight correction later in the day Friday, but overall for the week, we're up a little over 2%. So this week was a very busy week for the public account. And we made quite a few moves, both with buys and sells. And I also added a new position as well. So on Monday, the first move that I made is that I bought more Robinhood. I bought about $2 worth of Robinhood stock at $34.52 a share. And the reason why I bought it, I wanted to still buy the dip that we got after their earnings came out last week. Then a couple days later on Wednesday, I went and bought even more Robinhood. And this time I bought $4 at $34.94 a share. And again, the same thing, I was just buying the dip on it. And luckily I decided to buy Robinhood on Monday and Wednesday. I believe on Thursday it actually ran quite a bit. So I got really lucky when it came to buying right there. Also on Wednesday, I went ahead and opened a new position in Redfin. So after Zillow earnings and Zillow announcing they're going to be out of the iBuyer business, I decided to sell off all the Zillow I had in my portfolio. In fact, I don't have any Zillow in this account, in the public account, but I do have in some of my other private accounts. And honestly, I think it's like 0.01% of my portfolio. So I didn't really take that big of a loss on it. And I still think overall Zillow is still a good company. I think they're going to really hurt for the next 3 or 4 earnings cycles. But after that, I really think that this company will still do well as they're going to focus more on their main business, which is advertising agents. And they're going to get away from that unprofitable iBuyer business. So in the long run, it's a good thing that Zillow did close down this portion of their business. And after Zillow's earnings, their stock fell about 25%. And because of what happened to Zillow, it also dragged down Redfin with it as well. And for me, I really believe more in Redfin than I do in Zillow. And the main reason for that is because Zillow makes most of their money off of ads. And I'm not the biggest fan of investing in companies that make a majority of their money off of ads. This is the reason why I don't buy Facebook or Twitter or any social media stocks whatsoever. But Redfin, on the other hand, they make money off of real estate transactions. And this is why we've seen so much pain in their stock recently, because there's a very strong expectation that as interest rates rise, there'll be less demand for buying homes. And also with Redfin stock as well, I noticed that it started to hit a resistance line somewhere in the $48 range. And it's been hitting this resistance line for quite a while. So I decided to buy $4 worth of Redfin stock at $49.45. The one thing I will say about this position is that I really think that real estate related stocks, so Redfin, Zillow, EXPI, even companies like Rocket Mortgage, United Wholesale Mortgage, all those real estate and lending sort of businesses, I think they're really going to take a beating in the next couple of years as we start to pull ourselves out of this pandemic and the Federal Reserve starts to taper their purchases of mortgage-backed securities and they start raising rates as well. So in the short term, there's a very high likelihood that this company could take even more of a beating. But in the long term, I think Redfin's still going to do very well in the long term. So for me, I thought it would be a good idea to start buying in now into Redfin. But this is definitely a long-term play. I did tell you guys earlier that I did sell something. And what I did is I decided to sell all of my VTI position. I sold about $20 worth for a 2.5% profit. Not only in this account, but also in my private accounts as well. I sold most of the VTI that I had. You might be thinking to yourself,
why did you sell if the market's still going up?
Here's the reason why, and it's a little complicated, but let me break it down. So for me, when I go and invest my cash into VTI, the only reason why I'm doing it is to try to hedge myself against inflation. Since the entire market has been running, so has VTI. And for me, I realized that overall, throughout all my portfolios, I have about a 3 to 5% gain in all of my VTI positions. So let's just say for the year, inflation's at 6%. Most of the buying I did into VTI just started within the past couple of months. I've already covered 6 months of inflation in a matter of a couple of months. It doesn't make any sense for me to continue to take risk on that money when I could use that money to go buy the dip. And that's another reason why I sold as well. I wanted to have more cash on hand so I can buy the dip whenever that dip does come. If you follow the markets, you know that at some point we're gonna have some negative catalyst that is going to drag down the market. And I wanna make sure I have enough cash on hand to be able to buy the dip. And one thing I noticed as well is that anytime I put my cash into VTI, I have a very hard time selling it to go and buy stocks. So that was another reason why I decided to sell out of that position as well. So let's hop into my iPad and let's review how the portfolio is doing so far. Currently, the portfolio sits at $108.47. And just this past week, we did cross the $100 mark. And the portfolio overall is up $18.47, which is about 20.5%. So it's really kicking butt right now. So I know I made the rule that I wouldn't hold any cash, but I made the rules, so I'm going to break them. And I'm going to hold some cash. And like I said before, and that's for the reasons that I stated earlier in this video. So the first position is Enphase. We still have our Enphase. No buys or sells this week with Enphase. It's up over 50% right now, so it's really kicking butt. It currently sits at $26.09, and it makes up a little under 25% of the portfolio. The next position is Robinhood. And like I said, I did do some dip buying with Robinhood. It ran up a little bit after I bought, so I'm up about 6% here. It makes up a little under 16% of the portfolio, and that has been doing really good the past couple of trading days so far. So the next position obviously is Tesla. Again, kind of like Enphase, it's been kicking butt recently. Currently, we're up 66% on Tesla, so it's doing really good right now. It makes up about a little over 15% of the portfolio. The next position we have here is Lemonade. Lemonade has been doing well after they announced that they are offering car insurance. So the stock did run a little bit on that news. So we're up about 7.5%, or a little over 7.5%, and it makes up about 10% of the portfolio. The next position is Google. We're up a modest 5%. I don't really expect Google to run. They're such a massive company. It's really hard for those kind of companies to really build very quickly. It makes up a little under 8% of the portfolio. The next position we have here is Amazon. Right now, our position in Amazon's up about 1.9. So it's really falling behind from everyone else. And again, like I said, these big companies have a really hard time really growing. But I really think Amazon will grow well over the next couple of years. And that currently makes a little under 5% of the portfolio. So our last position in this portfolio is Redfin. Like I said, we just bought that on Wednesday. Currently, it's pretty much just flat at 0.5% gain. And it makes up a little under 4% of the portfolio. And as usual, if you guys want to see me make these trades in real time, check me out on Public. I have a link in the description below where if you use it to sign up for Public, you can get a free stock worth up to $70. So if you aren't on Public yet, check it out. So quick update on the AMC challenge. Again, like I said, I bought 4 shares of AMC at $37 a share. And at the moment, AMC is at $41.85 per share. We're up about 13% or a little under $20. And as usual, I am planning to hold this until at least the end of the year. So some important things that we should watch out for in the near future. When it comes to Congress, the House did pass the physical infrastructure bill on Friday night. They only passed the physical infrastructure bill, not the social infrastructure bill that has funding for green energy and social programs. Most likely stocks like Enphase and Tesla or those EV related stocks probably won't run because of this news. But whenever the social infrastructure package gets passed, then most likely those stocks will run because of that. But who knows? Maybe the market has already priced it in. Also, those stocks could not run off of that news as well, as it could already be priced in. Another thing we have to look out for when it comes to Congress is that we only have 4 more weeks until the continuing resolution runs out. So back in late October, Congress did pass a continuing resolution to fund the government until the end of the first week in December. And that means that we have 4 more weeks until that continuing resolution runs out. but Congress hasn't started talks on passing the budget just yet. So this is something that we do need to watch out for because I really think it could be a strong downwards catalyst for the market. And then also we have to consider as well that Congress still has to work through the social infrastructure bill as well. So they have a lot of things they have to do, and I'm pretty sure they're going to go on recess at some point for Thanksgiving and Christmas. So it's really crucial that Congress gets their act together and they get everything done so we can continue our flight to the moon. So when it comes to the Federal Reserve, the Federal Reserves did have their FOMC meeting this past week, and they did state that they are going to start tapering their purchases of mortgage-backed securities and bonds, and they're planning on tapering at a rate of about $15 billion a month until they've completely finished tapering, which they plan to stop tapering in July of 2022. And then at that point, they'll start hiking interest rates. And the reason why they're staggering the two is because it doesn't make much sense to push all this money out into the market and then raise the cost of the money. It makes more sense to pull one back and then the other, especially if they want to avoid a taper tantrum, kind of like they had in 2018. When it comes to inflation, I did say last week that it doesn't seem like the market really cares about inflation anymore. And that's why we're starting to see all these tech and high PE stocks start to run. But I did see an article that talked about how warehouse rents are skyrocketing. It seems like the main culprit of this is that big box retailers are trying to stock up in lieu of the holidays. So they're double and triple ordering to make sure they have enough stuff so that people can buy whatever they want during the holiday season. And for me, when I heard that news, I just thought to myself, well, it doesn't make sense if we're worried about supply chain issues, but then we have big box retailers double and triple ordering and having a hard time finding warehouse spaces. It doesn't really make sense in a market to have those two concepts happen and be worried about supply chain issues. So in the longer term, I am a little afraid that we may go from worrying about inflation to start worrying about deflation. As we have supply chains start to come back to equilibrium and we have way too much supply but too little demand to service the supply. For our tech-heavy portfolio, it's a really good thing, but for the market overall, this can cause some chest pains. We really have to look out for this, especially in spring and summer of next year, when we are most likely to see inflation start to move to the downside. So that's pretty much it for this video. If you found value in this, please like, share, and subscribe. If you want me to talk about anything in particular in these market updates, let me know in the comment section down below. Also, we did just start a Discord channel where we talk all things personal finance, stocks, real estate, anything that has to do with money, we talk about it. If you haven't yet, consider joining our Discord channel. Links in the description down below. Follow me on all my social medias. I try to post there as often as possible. And thank you for watching, and I'll see you next one.